Hey everyone, happy Thursday, March 20th. It's about 10:15 in the morning on the West Coast, and it's time for another market update. Well, this is a big week. It was Fed rate decision week. The Fed concluded their most recent meeting yesterday, and although the markets had already priced in that they weren't going to do anything, they weren't going to raise rates, they weren't going to cut rates, it's still really important because we get a lot of insight on what they're thinking is going to happen in the future. So let's get right into that. And like I said, starting with the Fed announcement. It was kind of if you look at their comments, a lot of it has to do with whether economic policy is going to create more inflation or is going to slow growth more, and they're kind of offsetting each other right now. So first thing I want to take a look at was a comment, some of the comments that Fed Chair Powell made. So basically, the Fed is saying that they're comfortable keeping interest rate higher, which we don't want, for longer if the economy stays strong. So basically, what he's saying is if the economy remains strong and inflation does not continue to move towards their 2% rate, which they keep talking about, they think they can keep rates longer, that we can maintain policy restraint for longer. However, he said if the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. So that's basically what we've been saying all along. If the Fed's two jobs are to keep employment strong and to keep inflation lower. So inflation comes down, jobs get a little weaker. That's when we're going to see them possibly cut rates a little bit more aggressively. So although they're saying they can't keep rates higher, they're also saying, yeah, if things change, we'll cut them. So that is good to see. The second thing that we get, a big thing we get out of this meeting from the Fed is they release their updated projections, the SEP, the summary of economic projections for 2025. So on December 18th, at the last time they released these, they thought the unemployment rate in this year would end about 4.3. Now they have it at 4.4, so that ticked up, meaning they think the labor market's going to weaken a little. GDP for the U.S. they had a 2.1% growth next year or this year, and now it's down to 1.7% growth. So again, that's good for rates. They're basically saying, hey, the labor market's going to weaken. We think the economy is going to weaken a little bit. However, the core PCE, which is the thing that they're paying the closest attention to, that's inflation without energy costs and food costs. They had that at 2.5% previously, and now they have it at 2.8%. So basically, they're saying that they think core inflation is going to tick up. They still have it at 2 cuts this year, which was good to see. So they basically think they're going to cut twice more this year for about a half a point off their Fed fund rate. So when it comes to this inflation, basically what they're saying is they think that tariffs are going to cause more inflation this year. So that's kind of like we've talked about. That's up to debate. It's going to take a while for those tariffs to take an effect and see exactly what happens. But according to the Fed right now, they're basically saying we think that's going to be inflationary. The GDP, however, they think is going to slow down. So these two ones right here, our economy slowing down versus inflation going up, they're kind of offsetting each other. And that's why the Fed fund rate kind of kept it 2 cuts. So overall, it wasn't the worst meeting. Again, it was kind of expected what they were going to do. They didn't say anything too alarming afterwards. It was good to see they still think there'll be 2 cuts this year. So again, it'll just be interesting to see, what happens over the next few months before that next meeting and to see what decisions they make. Right now, it's showing about a 15% chance they cut at their next meeting in May and an 85% chance they keep it as is. Next thing we got was February retail sales. And like I say here, it was mixed data, so it was a mixed reaction. So the first thing we got out of it was the headline number. The headline number came down quite a bit. The headline number was only up 0.2%. It was supposed to go up 0.6%. They also made a negative revision to January, made those numbers even lower. However, the core, the control group, as you can see, this red one, that jumped a little bit higher. So that came a little bit higher. So, January's was revised lower as well, just like the headline was, but that jumping a little bit higher kind of, spooked the markets a little bit. So, if they come in line with each other, headline down, core down, that would have been a lot better for us. So, overall, though, the Fed also said that it looked like there was moderation in consumer spending. So, Americans are still spending too much money, but it looks like we're doing a little bit better job about it. Next thing we got was February starts and permits. So this was up from January as well. This is again, this is new home construction. So, starts and permits and construction, this is all very important to look at because it gives us an idea, our first look at future inventory, future homes. So, as you can see, starts, construction, completions all rebounded. I'm sorry, not completions, but starts and construction, rebounded after a pretty weak January. January numbers were really low. There's a lot of bad weather across the country. There was fires on the West Coast, things like that. So those bounce back, but permits, which is really our first opportunity to see, that's the first thing the builders are going to do before they build a house is pull permits. Those were down month over month, still about negative 1.2% and down about 7% year over year. So like I've said before, we're still lagging behind. We're still not building enough homes to keep up with demand. So that is very good for current homeowners, not necessarily good for people that want to see, an influx of a bunch of inventory out there so prices drop. Next thing we got just today was February existing home sales. So homes that closed in the month of February when rates were in the sevens, those actually jumped. It was supposed to be coming at -3%. It came in at plus 4.2% month over month. Year over year, we're still down about -1.2%. Median home price ticked up a little bit. Inventory ticked up 5%, and now it's up 17% year over year at 1.24 million units. So that leaves us at about a 3.5 month supply of inventory in the markets. Normal market's 4.6, so we're still behind that, but obviously it's going up. Still behind, what would be in normal times pre-COVID, but we're definitely have more inventory out there than we did a year ago. And then days on market has ticked up as well. Homes when they're listed, it's gone from 38 days on average to 42 days on average. So, again, seeing more inventory, good to see more activity even with rates higher. A lot of people are just kind of getting used to the rates. There is more inventory out there, so there's more choices. So people are making that jump even with the higher rates. So good to see, some of that demand being met. And it just goes to show that if we do have rates come down, you'll see these numbers go up dramatically because there's a lot of pent up demand. Next thing, initial jobless claims. When people first file for unemployment, still kind of hanging out pretty low. Estimate was 224,000. Came in at 223,000. Be interesting to see when this ticks up, but this has been low for a while now, pretty consistently kind of in this range. Next thing we got, so average 30-year now is down to 6.71. Last week we were at 6.82. Again, yesterday didn't help things. Got some pretty good data this week, so trending in the right direction. It would be really great to get to that 6.5 mark, and then work our way back to 6, which we got into in October, and then we had that bad jobs report, and rates jump back up. So if we can get a 5 in front of it somehow, even if it's high fives, obviously that would be great for everybody. So important dates coming up. So we have the next PCE inflation data comes out a week from tomorrow. That's going to be a big one. BLS jobs report the week after that. That's the big jobs report, and we'll get all the other job data that week. We have a CPI inflation data on April 10th, and like I said, the Fed meets on May 7th again. We get another PCE, I believe, and another BLS jobs report, right here in between those. So we'll have a lot of data come out between now and then. I'm sure there'll be a lot of new political things that come out as far as changes in our economic policies that could affect the market. So a lot can happen between now and May 7th. Right now, it's looking like they're going to pause again. But like I said, there's like they said in their comments, if things change in the labor market or inflation starts to come down, there's a chance that they would speed up those cuts. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope everybody has a great week. Thanks a lot, guys.